Hello, I'm Tony Kaye. I'm the editor of Eureka Report. And I'm joined today by Neil Margolis, Managing Director of Merlon Capital. Welcome, Neil.
Thank you. Thanks, Tony.
Neil, I wanted to have a chat about this report that you've just produced on Rethinking Retirement Asset Allocation. It was a great report. There's some interesting stuff in there. So I was just wondering if you could run through it for us.
Okay, thank you, Tony, and thanks everyone. Yes, the thinking is that Australian shares actually offer really attractive income relative to other asset classes. The dividend yield on Australian shares is typically equal to or higher than the cash rate, and particularly at the moment when the cash rate is very low and bank deposits are low, the yield on shares is very attractive, sometimes twice as high as the risk-free rate you can get on a term deposit. In addition, you get very valuable franking credits from the imputation system, which means that if the company's already paid the tax and if you happen to be on a zero tax rate, such as in the pension environment or in super, you actually get a further income of 1 to 2% on top of the dividend yield. So it's very clear that Australian shares offers one of the best incomes out there. Also, investment in Australian shares is liquid, meaning that you can get your money back basically a daily basis from funds, whereas sometimes in term deposits you don't quite have access to your money if your circumstances change. So the things that are going for it are obviously the high level of income, the high tax efficiency of it, and the liquidity of investing in Australian shares. The issue that worries everyone, particularly people in retirement, is risk. The risk of losing, of losing their capital.
Yeah, and of course, a lot of people go into retirement and they go, I'd better switch to low risk assets, fixed income, cash, and of course they're not earning the returns that you would get out of shares, but there's ways around it, isn't there?
Yeah, so people have prioritised, and correctly so, they're focused on risk of protecting their capital, but in doing so they've given up income, they've given up the franking credits, and they've given up long-term capital growth. And the way to think about risk is twofold. I mean, there is short-term risk of losing money if the share market dips, but there's also long-term risk. People are obviously living longer, which is a good thing. But inflation, and the point we make in the paper is inflation is still there, particularly in things that matter to people near retirement, such as aged care costs, healthcare costs. Some of the deflation we're seeing is in clothing and other areas which are probably a smaller share of wallet for retirees and things like healthcare. So inflation is still a real issue. So people are living for 10 to 20 years. The other risk is that the capital doesn't maintain the value in terms of what it can purchase over time.
And you talk in the report about hedging strategies. I wonder if you could just explain that.
Yes, okay, so the one approach is to say, okay, we know we get better income out of Australian shares, we know we get the franking credits of Australian shares, you just ride out the volatility, and long term you'll also get capital growth. We thought we could do something more than that, more than just saying we'll invest in good companies. We actually also have an overlay on the fund which provides downside protection. So put simply, what it does is it creates the risk profile of being 70% invested in the market and having 30% say in term deposits, but you get the full income and franking credits of having 100% invested in the strategy. So we're removing 30% of the risk, but keeping 100% of the dividends and franking credits.
So the investor is basically getting the protection through options, is that right?
Yes. What we do is we say that we fully invest in the 25 to 30 best ideas, but we recognize that there's some short-term risk. So we want to remove 30% of the risk, and we just do that. We look at the portfolio and we remove it from the companies that we think have the greatest short-term risk. They all have good long-term upside. They're all good companies generating cash flows, paying dividends. Some have more short-term risk than others. We try and identify that and hedge out that short-term risk. But it has the effect of overall creating a 30% cash-like risk profile while being fully exposed to the income.
And I think it's a good thing for retirees to think this way, because so many people do retire and go into as I said before, go into low risk strategies, but the money just won't last that way. Yes. You have to look at alternatives. Yeah,
so there's two ways I guess you can think about it. If you're already exposed to equities in retirement and you're enjoying the income and the franking credits that come from equities, you could switch into this fund, and what you do is we actually have more income and more franking credits than a typical share fund, but we also have that downside protection you're referring to. So if the share market, for example, was to fall 10%, the fund should fall 7%, subject to obviously whether our shares actually do better or worse than the market, but at a broad level we've got that downside protection. So you end up with a more defensive outcome than just being in shares, and you end up with a bit more income and franking credits as well. The other alternative is to say, well, perhaps I've got too much cash. I do need more income. I need more long-term growth for inflation, as we discussed earlier. But it's not as full-blown as just investing in a share fund that has that moves up and down with the market. So you can either like partly fund it from some of your cash holdings, as I said, or you can fund it from a shareholding and become more defensive. I guess it depends on the starting point.
Yeah.
But it allows you to have a share fund that has this inbuilt protection and the high income allows you to be quite creative in the way you actually set up your strategy in retirement.
Well, as I said right at the start, it's important for people to think this way and to look at equities as something that you can do in retirement rather than something that you should avoid.
Yes, and also look, I mean, we pay monthly income as well, and we smooth out that income. So for 5 years now, we've been paying the same or slightly higher monthly income every month. The income itself doesn't change the total return of the fund, but what it allows people to do is not worry too much about volatility in the actual unit price. So the capital value will go up and down with the share market and whether or not our investments do better or not. But ultimately, if they're getting the steady income, that can allow them to take a really long-term view on the capital, as opposed to kind of having no risk capital, but over time it doesn't keep up with inflation.
Okay. Well, Neil, thanks very much for coming in today. I really enjoyed our chat and reading the paper, and look forward to talking again soon.
Thank you, Tony. Thank you very much.
I'm Tony Cowan, the editor of Eureka Report.